Okay. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Monday afternoon, we have Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq 100. And Chris, in addition to geopolitics making the headlines this week, of course, CPI data is really going to be in focus as we get, a more complete picture into what's happening with inflation. Although, it's pretty clear from what we're seeing at the pump and in the food stores, it's here and it's real.
It's absolutely real. I mean, if you want to throw another wrinkle on top of the CPI data, just take a look at last Friday's non-farm payroll report. Top line numbers look great. Labor force participation looks great. What doesn't look great is that there's zero wage growth on a month-over-month basis when we're looking for 0.5% growth. So that's really bad for the U.S. economy. That's bad for U.S. GDP. That's bad for consumer spend all around. Remember, nearly 2/3 of U.S. GDP is made up of consumer spend. So if people are making less money and people are expected to pay more for the basic items that they need, whether it's staples, gasoline, heating oil, et cetera, they're going to be spending out of savings, which is what we already saw last month. And the question is, without government stimulus, how is that going to pan out? And you can see how it's panning out. People are going back to work, but the real bump hasn't come yet. With the March meeting with the Fed, we're expecting a quarter-point basis, basically reiterated by Chairman Powell up on the Hill last week. So look for that to come through, and then the wording around that. Ideally, though, everything centers on what's going on in Ukraine with the Russian invasion. The president of the country that invaded Ukraine is not even worth mentioning anymore. He's such a tyrant. But that's just a personal opinion, not Nasdaq. The question here is, when will that end? And what will that mean to the future of the global economy? And that's what we're waiting to see right now.
Right. And Chris, before we get into your charts here, let me throw in a fundamental question. So we get 25 basis points, even if we get the 50 basis points, which, that did a total 360. It doesn't appear that that's going to be happening.
Right.
What will that really do to curb inflation? It feels as if the Russia-Ukraine conflict, which is going to have global systemic effects on certain parts of the financial system. We know trade in energy and other commodities. I mean, also look at the softs. How much production with the soft ags come out of Ukraine and Russia. Are those basis point hikes, are those rate hikes going to do anything that will in fact curb inflation? There's too much demand, not enough supply. Trade routes need to be refigured. You can't fly over, certain parts of the world. What are your thoughts there?
Yeah, it's a hell in a handbasket, right? At the moment. So what you're looking at really is the Fed has to stay the course. I mean, you look at their mandate. Their mandate is not to worry about geopolitical events, though they are doing the right thing and taking into effect here something that is really global. And, being the lead, the world's reserve currency, the dollar, and the unemployment moving in the right direction, inflation's gotten out of hand. Now, the energy imports, forget about the price of gas at the moment, because that'll correct itself over time. I mean, we saw a $130 barrel today. Everyone wants to hype on what you're paying for the price of gas, and it is eating into your pocketbook. But what you have to worry about is not just those small road bumps along the way. What you have to worry about, is it a sustainable inflationary item, and will $4 gas be really where we're at for the next 2 to 3 years? If it's a 3 to 6 month item and the conflict in Ukraine works its way out and the U.S. starts to ramp up their own domestic production, and if the imports start to keep working as favorably as they should, where we were years ago, not even that long ago, a net exporter as opposed to a net importer, the question is, will that work? 7.5% inflation on the other side of it continues to go. And that's where the Fed kind of got it wrong. They did what they had to do at the time, and everyone's very thankful for that. But now playing out in the longer card of it, they should have suspended asset purchases 5-6 months ago. That unwinding of the balance sheet is where it's going to come in to play and see who the net buyers are. The broker dealers, on the interdealer brokers on the bond markets and the MBS securities are going to be the net purchasers here, not the Federal Reserve anymore. So you're going to see some price movement within those assets on a need-to-be basis, which is where it should be. I think inflation comes back down over the next 6 to 12 months. I think the Fed will be at 1.2 to 1.5 by the end of this year. I think every meeting is going to be live at a quarter point. And depending on how quickly the Ukrainian crisis works its way out, one way or another, you can see a 0.5 point move once that's done and stabilized. Either way, we're going to be at 1.2 to 1.5. That inflation rate will offset the interest rates and should, on the savings, on real interest rates, bring things back into alignment.
Right.
And that make the earning power a little bit more for each individual. Until that happens, so the next 6 months is going to be tough.
Right. Yeah, Chris, I would agree. I mean, anecdotally, my car used to cost somewhere in the 40s. I have a small SUV to fill up. I just spent over $70 on Sunday. And you and I had the benefit of being able to work from home, and we commute on mass transit from New York and New Jersey into the city. There are many, many people who have to drive. Their jobs require them to do so. That's just such a big hit, and it can only go on for so long. So certainly, want to be cognizant of that. Let's get into the charts though. Let's pull up your first chart here. Let's look at some fresh technical levels on the Nasdaq 100.
Right. So we obviously been under pressure. Tech has been the bad boy lately. We're down on the 100 over 17% year to date. Though on a yearly basis, year over year at this point, we're still up 6%, and the index is still up over 60% from the pandemic lows back in March of 2020, so just 2 years ago. The index is tight here. We're still in the RSI, if you look at the bottom, we're still nearing that oversold condition. We bounced off it a few times. You've seen that pop like what we talked about last week, and you got a little bit momentum on that. But right now, support is tight. It's 13,345. If that breaks on a closing basis, we're going to 12,950. Resistance is overhead at about 14,000, a little bit below. And that break point, if we don't hold the 13,345 level, we're going back to March of 2020, 2021 prices, which is a year ago, basically wiping out the move that we've seen all of this year.
All right. And our final chart here, of course, we'll take a look at the stocks that are, I guess, relatively outperforming what's been a really tough tape.
It is a tough tape. Like I said before, the top 10 tech names across the board are getting hurt pretty badly. And in the top 6 are down anywhere from 10 to 12% since this recent highs. Names like Amazon, Microsoft, Apple, Nvidia, Meta, Alphabet, et cetera, all getting hurt here. The travel names are also getting hurt. So I do have to admit, I am traveling over the next couple of days. I had to rent a car and I couldn't get one. I had to go to 5 different car rentals to get one. So there are plenty of people traveling, but the expectation is that it will be light. So you're seeing those names like Expedia and Booking getting hurt a little bit as well. Really, we're only about 15 to 85 plus to minus.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.